Good afternoon, everyone. Welcome to the Springboard monthly webinar series. My name is Lyle Martin, CEO of Springboard Equity. For those of you who have joined us before, you know our previous formats have been entrepreneurs in more of a pitch style format. Today marks the first in our planned educational series focusing on early stage investing, both from an entrepreneur and an investor standpoint. Today's series is titled Demystifying Angel Investing. For those of you new to Springboard, we are a professional services and equity investment marketplace dedicated exclusively to the healthcare industry with a mission of connecting capital for early stage companies while giving investors access to unique deal flow. If you haven't yet had the opportunity, I would encourage you to check out our website, springboardequity.com. Just this week, we have expanded our platform to provide some additional services and marketing tools for our entrepreneurs and our companies to increase their exposure to the investor ecosystem. Such as that, part of that is including our webinar series and our monthly pitch events. However, today we are very excited to launch our educational series with our partner, the Rockies Venture Club. Since 1985, the Rockies Venture Club has connected entrepreneurs with angel investors, venture capitalists, service professionals, and other business and funding resources. RVC is an angel group whose mission is to advance the economic development in the Rocky Mountain region by actively connecting investors with the most promising entrepreneurial companies by offering education for both angel investors and entrepreneurs. They host various groups and events throughout the Rocky Mountain region, including some conferences such as the Angel Capital Summit and the Colorado Capital Conference. Today's host, we are joined by Peter Adams, the Executive Director of the RVC. His role includes creating deal flow for 500 plus firms per year, developing best practices for due diligence and negotiation, while providing education for angel investors in the areas of valuation, term sheets, negotiation, and portfolio strategies. Peter himself is a serial entrepreneur, having founded 5 companies and also served over 13 years as the economics director and CIO of an international professional services firm. Peter is also the CEO for bizgirls.org, a nonprofit summer camp for high school girls to learn entrepreneurship, and OmniPortraits, a for-profit e-commerce venture. And last but not least, Peter is also the co-author of Venture Capital for Dummies, which was published in 2013. So hopefully, regardless of what our level of confidence or intelligence is in this area, we look forward to hearing from Peter today. Before jumping into and turning this over to Peter, just want to remind anyone that if you have questions, please utilize the chat box to the right-hand side. At the end of this session, we will have about 10 to 15 minutes for some Q&A. Also, this will be the webcast will be on video available after the fact, and we'll send out a link later this afternoon or tomorrow with that videotape link. At this point, I will turn it over to Peter.
All right, thanks, Lyle. So, should I go through this legal disclaimer? We good on that?
I think we're good on that.
Okay, excellent. Thank you. All right, well, thanks for coming. I've got some interesting things that I think will be helpful to anybody who's an angel investor or who is looking to work with angel investors. And so we call this Demystifying Angel Investing. And just by way of introduction, I'll add that I also do teach an MBA class at Colorado State University, and I love teaching this because it's the capstone class at the end of the MBA program, and I can tell people how everything they've learned in 2 years of business gets turned upside down in angel investing. So I'm going to talk about some of those things today and some of the things that angels need to know, and some of the things are, there is a mythology around angel investing, and so I'm going to try to clarify what's really important to be successful as an angel. So Lyle already covered my background here, and Dave Harris is with us here. He's the operations director at Rockies Venture Club. So the first thing I've seen a lot of is people saying that for angel investors, valuation just doesn't matter. And I'm here to say that it does. And if you look at all of the deals that have happened over the last 5 years, the average has gone from something like 2.1 million up to 4.5 million. Now that's not companies that are moving along and getting bigger and bigger. Those are all of the new angel level deals that are coming into our deal flow. So we're seeing a disturbing trend in valuation where it's gone up over 100% over a relatively short period of time. And there's a lot of consternation in Wall Street Journal and other publications about whether this is a bubble or not. And we're hoping if it is, it's a slowly deflating one. It's related to a number of things. One would be the presence of unicorns, the private companies of $1 billion or more. Another would be up until this year, there were quite a good M&A environment, so people were getting acquired at higher and higher amounts. And a third is a lot of companies are coming out of accelerator programs who sort of tend to puff up some of the valuations of the companies coming out of their programs. So we're seeing a valuation trend among some of these parties that are really driving things up. Our mission is to bring things back down to earth so that angels can get reasonable returns. And we can control our returns by controlling how we get in the first place. So the second thing, and this is really interesting to me, is that exits are the #1 issue. And I've seen a lot of things. I just saw Mark Cuban posted the top 10 things an entrepreneur needs to do. And #2, I think, was not to talk about exits because he would become disinterested immediately. And I'm here to say, he's a smart guy and very successful, but exits are the way that angels get their money back. We see a lot of pro formas that show, millions of dollars dropping to the bottom line. But if we've invested as equity investors, we don't receive a penny of that. Angel investors only receive money when we have an exit. And so we like to have companies who have a really clear idea of what their exit's going to be, when it's going to be, what the multiples are in their industry, and how they're creating value for the companies who might be acquiring them. So we like to say it's almost like having 2 customers. You always ask an entrepreneur, what's the most important thing? And it's knowing who your customer is. Well, whoever buys your widget is one customer, but who's going to buy your company is a different customer, and there's a different value proposition. And we like to invest in companies where they understand that, and they're building that value proposition in from the beginning. The other thing that's important here is if you look at just the way finance works in angel investing, the multiples we're looking for is something like 10x over 5 years. And if you plug that into Excel, that comes out to a 60% IRR, or internal rate of return. If that means if you exit in 3 years, you might have a 3.5x, 5 years would be a 10x, 8 years would be 40x, and 10 years would be 100x, just to keep that same return. So somebody who has their eye on the 8 ball and can exit early is what we're interested in. So the third thing is wisdom of crowds. And we're really interested in this concept of wisdom of crowds. At RVC, we've got 6 angel groups, and we do a road show every month taking companies to these angels. And it's fascinating to see when you get a lot of smart people with sector expertise working together, sharing information, how much better decisions you can make than you can make as an individual. So a lot of people say that you can't really find out much about a company just by talking to them. But if you have 100 people, 200 people talking to companies and sharing that information, you can really do a lot better as an investor. So, and for Springboard Equity, it's a platform that's working primarily in health sciences, healthcare, life sciences. So investing in what you know or seeking out that expertise and partnering with people who know that is a key to angel investing success. So the next myth about angel investing is that you can't do due diligence because there's nothing to look at. A lot of people say there's no financials, there's no past history, you really just have nothing to do, so you might as well just do what we call beer and a check. See if you like the entrepreneur, go with your gut, and write a check. And there's certain people who are sort of espousing this as a philosophy of angel investing, which we call spray and pray, meaning just write a ton of checks, don't think about it, and pray for the best. These people, ironically, also say that angel investing doesn't give very good returns. And that's true for them because they're not doing due diligence. The chart we've got up on the screen here shows that angels and angel groups who do high due diligence can get up to 5x more return than those who don't do much at all. So the deals that get 10, 20, 30 times returns, those come from the deals where the angels have done a lot of due diligence, who've been involved and have invested in the companies that have more discipline and more focus on where they're going. So, we spend a lot of time, maybe 40 to 100 hours at least on each deal, and write up a 20-page report to synopsize what we're looking for, identifying key risks, the market, the team, the intellectual property, all of those things, and that leads to much higher quality success in angel investing. So one of the things we look for in due diligence, and a lot of angels overlook this, is poor marketing and poor execution. And it turns out that the number one reason for failure of the companies we invest in is they don't have a really good marketing concept. Angels get all excited about the business and they think it's a great idea, but it turns out that it costs a lot to reach the customers. So when we dig into due diligence, we also look a lot at the marketing plan and the go-to-market strategy. What are the channels they're using? What kinds of tests have they done? What's the cost of acquiring a customer versus the lifetime value of that customer? And have they really done things to validate that and test? When you think about angel investing, we're on the cusp of revenues, so we want to make sure that we're working with companies who are understanding that they're moving out of R&D stage and into marketing stage, and they can't just take that for granted. Next principle is important. Don't invest in ideas, invest in companies. We've seen a lot of angels who get really excited about an idea. Maybe it's in their sector, so they could see how it could be helpful. But when you look at a pitch, typical 5-minute pitch, we coach people not to spend more than 60 seconds on the idea itself or on the product. The rest of the pitch is on the company. It's on the team, the market, the competition, the go-to-market strategy, the finances, the deal. All of those things are as important, if not more important, than the idea itself. So I sometimes see a pitch where somebody pitches something and I go, wow, that's really cool. I'd love to have that thing. I would buy that, but I don't like the company, so I wouldn't invest in the company itself. And then other times I see things that are just the opposite. I like the company, but I don't really need to buy the product. So for angel investors, the important thing to realize is an idea itself is not a good investment, but an idea with a great team and concept and strategy behind it, that's the company to invest in. So when people talk about teams being the number one thing that we should be looking at, David Cohen, the founder of Techstars, said there's 5 things he looks for a deal, and it's team, 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 a great idea, and a big and rapidly growing market. So clearly team in that metric is 60% of the value. And in fact, in some of the valuation models, it is 30, 35% of where we attribute value in a company. One of the things we look for in the teams that we work with are ones who do the planning work to de-risk before we write a check. So some companies, they're just sort of, they're launched out of an accelerator, or maybe they've only been in business for 6 months. They haven't really understood their market deeply. They haven't done a lot of scenario analysis. They haven't analyzed the risks and worked out mitigation strategies. They haven't done multiple ways of looking at things through their pro formas and how the numbers are going to work and what the details of costs are. And we found that those people who don't do that work are the ones who are less likely to be successful. And I'll just put a bracket around that and say there's lots of exceptions, and I certainly have seen some of them. Somebody who's been through multiple venture-backed rounds before, they can do these things intuitively. The rest of us need to do all the homework and do all that background, and those are the people who we think are going to be successful. One thing I hear angels say is, or former angels, they say, yeah, I invested in 1 or 2 deals, they didn't do so well, so I'm not doing that anymore. And the numbers show if you invest in 1 or 2 deals, you're probably not going to do well. So I'm never surprised when somebody tells me that story. But I have never, ever heard somebody say, I invested in 10 or 20 deals and I didn't do very well. So people who diversify give themselves the opportunity to get on board with one of those home runs. And we look at a portfolio of 10 as a minimum amount that somebody should be investing in. And if somebody invests in 10 companies and half of them go belly up and a few get 2 or 3x and one gets 10x, you're still going to get something like a 27% return on investment, 27% IRR over the period of your investment. That's an awesome return compared to the people who do just 1 or 2, where they might get 0 or less return on their investment. So diversification is a key principle. And when I talk about diversification here, I really just mean be in a lot of deals. It doesn't necessarily need to be in a lot of different industries or whatever. It just means these deals are high risk, but they're also high return. So the way you deal with any sort of a risk scenario like this is to diversify into lots of deals. And those that do well will pay for those that don't. The next principle is deal flow. And this one's really important. If you're on a platform like Springboard that gives you sort of a steady flow of really high quality deals of the type that you're looking for, this is really important. We see between 500 and 1,000 deals a year, and without that, I don't think we could get the sort of things that we're looking for. There's a funnel that most VCs have that starts at maybe 1,000 coming in the funnel. They'll look deeply at maybe 100, and then they'll invest in maybe 10. So that's sort of a typical VC model. Angel investors should think of a similar sort of a funnel, maybe smaller for themselves, but where they certainly are thinking that they want to have at least a sizable number of deals that they look at, and they should have a feeling that they can look at lots and lots of deals, and they don't have to pick any one or the other. They don't have pressure just to pick because that's the only deal they're going to see this month, for example. So seeing lots of deals also educates angels and lets them see where the bar is set in the community. And the more deals you look at, the more you can spot the red flags or the green flags, the good things that you see in companies. And so that leads us to our last slide here, which is I call 10,000 hours. And this is based on the Malcolm Gladwell principle in the Outliers book. And this is, he has Outliers. If you haven't read it, it's a great book. And Malcolm Gladwell is a great storyteller. And he tells stories of different people ranging from Bill Gates to Scott McNeely to the Beatles and hockey players, talking about this magic number for true expertise is something like 10,000 hours. And these people were able to get that expertise early in their careers, and it led to career success. So his point there is the people who are outliers also have this sort of extraordinary amount of experience. So being an angel investor is based a lot on experience. And that's why we say it's good to invest in the areas you have experience in. But looking at deals, looking at term sheets, deal structures, understanding exits, looking at risks, evaluating the ability of a team to execute, those are all things that the more deals you can look at, the better. So good to be on platforms that will give you lots and lots of deals, work with other angel investors, share ideas, share risks, share opportunities. A lot of times angels are bringing a lot of value to companies other than just a check. So when we can work together and dig in, we can provide a lot of value to the companies we work with. So those are the top 10 things for demystifying angel investing, and I think we've got some time left for Q&A.
All right, thanks for the presentation, Peter. That was excellent. This is Wally King at Springboard, by the way. I'm the VP of Marketing here, and I'm going to go ahead and facilitate the QA session. We've already had a few questions come in, which we'll address firsthand. And by the way, right now, if you can look on the right side of your screen, there should be a chat window, if not a chat icon that you can open up to view that window. And you can go ahead and type in any questions you have there, and we'll go ahead and answer the first set of questions that we can get to that will cover about 10 minutes of time. Any questions that go unanswered, we're going to go ahead and email out to the whole group. We'll send also along with the Q&A for all those that were answered as well, so that you can all have a copy of that. By the way, some of the attendees are speaking about having some bandwidth issues. Don't worry about that. If you are, our apologies. It sometimes can be a little demanding, especially if you're in a building with shared internet connections. The video feed is being captured real time, and we're going to be sending out a recorded copy of this later tonight, so you'll get a copy of that as well. So I'll go ahead and start out with the questions that have come my way first, and then as everyone else continues to type in questions, I'll go into those. All right. Let me get in here. Our first question here from Alicia. She knows of a company that's raising $8 million pre-money valuation, and they're pre-revenue. She says she sees the deal is closing soon, but isn't sure how that could be. So how is a company able to raise funds at that valuation? And it seems like there's a number of angels that are willing to invest in that at that valuation.
Well, that's a great question. We're seeing more and more of these $6, $8, $10 million deals, and some of them, maybe they're worth it, but you mentioned that it's a pre-revenue deal, which is definitely a red flag. Now, with medical device and healthcare type things, there are things other than revenue that are going to add value. So, for example, if they've got CE mark and FDA approval, if they're a device, $8 million might be an okay valuation. They need, of course, to get those approvals before they're going to be in revenue, and it's a giant risk hurdle. So as we look at it, as risk is reduced, value is increased. So in medical devices, if you have somebody who's got CE mark and FDA, and they're at 6 to 8, that might actually be a good deal. If, however, they're still in development and have some more development work to do, and then, of course, regulatory approvals, then I would probably say that deal might be worth something more in the $3 to $4 million range, and I'd probably bow out on it.
All right. Thanks for the help on that, Peter. We've got another question here from James. What are the top 3 criteria angels look for?
Well, I think the top 3. The first one I look for, frankly, is this really an angel deal? And there's sort of a bifurcation that happens on the deals I see coming in. I'll see, Pilates studios or, cupcake companies, things like, just things that are really not meant to be venture companies at all. So those get knocked out. So, I referred earlier to the 60% IRR, the potential to get that 10x over 5 years. That's probably the first thing I look for. Is just if this can't return this kind of return, then it's not something for me. The second is I'm always looking at the exit and how the entrepreneur is focused on the exit. It turns out this is an entrepreneur thinks and what their strategy is going to be in terms of how they execute it. So companies who have a great focus on the exit, who understand their market, and frankly, it's really fascinating just looking at how people think. And if they can see who the big players are in their market and where they have gaps, and then they cater their company to fill those gaps, that's just really exciting to me. I'm also going to hope that they understand the revenue multiples for their industry, and they're going to be able to share that and understand how to maximize those multiples. So that's the second. And then the third is related, and it really is all about the team. And the reason people say team is so important, I've seen a lot of people get confused about what it means to have a great team. I saw one company get up and they said, hey, here's Bob, our CEO. He's a Frisbee ultimate champion, and here he is with his dog. We have a great team. Or another one that showed, 3 programmers sitting in the basement, doing some, cannabis tech deal. The problems with these companies is that they don't really realize what a good team is. So some of the characteristics I like to see is a fully rounded team, a team that has both marketing, finance, technology or product development, and leadership and strategy. And if they can hit on all 4 of those areas, then they're going to be a lot more interesting than somebody who's just a bunch of tech guys who really don't understand how to market it, which is really going to be our primary risk. Some other things I look for is when you work in a venture-backed company, it's unlike working for any other sort of company. So I like to have at least 1 or 2 people on the team who preferably worked for venture-backed companies or even have been CEO of a venture-backed company, and ideally have gone through a venture-backed exit. So they sort of understand the full life cycle. They learn that you're basically on track to double every year in revenues, and how to do that kind of ultra fast paced development. So that sort of culture of venture-backed companies is important. And then the final thing is, frankly, just the quantity. If we see one person on a team, that's really not enough. 2 is minimal. 3 is sort of average for a pre-revenue company. But when we see 5, 6, 10 people on a team, now we're realizing they're able to get more people engaged, and that they've got more horsepower to execute the plans they're presenting to us.
Great. We've got another question from James, but there's a lot of other questions, so we'll handle that one offline, James. Moving on to Carl. How do you approach the valuation challenge, which actually is very similar to James's question?
So this is one of the things that we really spend a lot of time on and focus, and we actually build valuation into every one of our due diligence documents. And a lot of people say you can't do valuation on these pre-revenue companies, and we think that's ridiculous. A lot of people do uncapped convertible notes and say we're going to kick the can down the road and let a VC value that for us later. We also think that's ridiculous. Angels have all of the tools available to them that VCs have, and there's no reason we shouldn't be able to come up with valuations. Now, there is a huge amount of uncertainty, so I understand the question, and it's really important. You certainly can't, take a revenue multiple or EBITDA multiple or something having to do with assets, from a company that has none of those 3 things. How do you multiply 0 times 0 times 0 and get $3.5 million? So the way we go about it is we minimize that uncertainty by doing 5 different valuation methods. We've looked through dozens and dozens of methods, and we've selected these 5 because they poke at the valuation question from different angles. So some, like the venture capital method or a modified venture capital method that takes multiple rounds and dilution into account, those are sort of a variation on DCF models, discounted future cash flow models, if you've taken valuation in grad school. So those basically are saying, all right, we're going to model the exit. We're going to say this company is going to exit at $100 million in 5 years. Well, if we need to get 10x, that means we need to have something, and it was going to be just 1 round of investment, then we need to have a valuation excluding our investment including our investment rather of $10 million, so we can get the 10x. Frankly, by the time you get to 100x, you probably had 3 or 4 rounds, so it's going to be a different set of numbers. But anyway, so we do a discounted cash flow model based on exit and discounting back using that 60% number as the discount figure. The second way we do is the scorecard method. And this is more like real estate, where you based the value of your house on comps, so the other homes in the neighborhood. And basically what a real estate appraiser will do is look at your house and the other houses, and they'll say, well, that guy's got 5,500 feet, you've got 5,000 feet, the guy next to you has 4,500 feet, so we're going to add and subtract $300 a foot for those. They've got an extra bathroom, we'll add another 25 grand for that. And they add and subtract of the various features of the home. That's how scorecard method works, except for startups. We start at the average valuation that startup companies are receiving. So we start with the comps, and we do a lot of research into the comparable transactions. And then we're going to use the team. We're going to use the product. We're going to use the size of the market, size of opportunity. We're going to use the competition, market opportunities and partnerships, and finance restrictions that you'll have coming down the road, things like that, and we'll assign values to those, and then come up with a multiplier. So if we start with an average valuation of a company, say at 3.5 million, we'll go down those 5 or 6 criteria, assign values, and it'll say, okay, this is a little bit better than the average, so it's going to come in at 4.25 million. Another method we use is a risk-adjusted model, where we're adding and subtracting value based on the various risks the company faces. Other ones are based on finance considerations, so we just do all of those. We come up with a composite, and we see what the average of the 5 different methodologies is. And then we look at the standard deviation. How much are they different from each other? And if they're really close, we've got a pretty solid valuation. If not, we've got a range usually of maybe $500,000. So we might be able to say our model shows that we're somewhere between 3.75 and 4.25 million, and that designates our negotiation range.
All right, thanks, Peter. Quick question from Don. He wants you to define the term exit.
Great question. So, and it's a great question because it's really misunderstood. Sometimes I'll ask an entrepreneur what their exit strategy is, and they're like, well, I want to get out in 2 years and have $10 million. And I was like, well, that's not really an exit strategy. And another thing somebody will tell us is our exit strategy is M&A or IPO. And that's not really an exit strategy, although that does define the main scope of 99% of exits. So exits are not the CEO leaving the company. In fact, most of the time the CEO and management team have earnouts, and basically they have probably 2 years of indentured servitude after the thing happens. So if they think their exit means they get to go and live on an island, they're sadly mistaken. So what exits are is a liquidity event. And that means usually it's an M&A transaction where the company is being bought by a larger company, or an IPO. And those divide up fairly unevenly. It's something like 98% of companies are going to have an M&A transaction, and maybe 2% will have an IPO. So you want to look at what the opportunities are for these companies. So it's exit is liquidity event. It's giving money back to the investors, and usually it's being acquired by another company. And one more thing I'll add, by the way, is some of the people who are critical of talking about exits say it means that if the founder is talking about exits, it means they're disingenuous or they just want to flip this thing. And I will say there are people like that, and I'm typically not interested in investing in them. I want somebody who's really passionate about the business, and the reason they're working towards an exit is they realize that being acquired by a bigger company gives them the resources in terms of capital, in terms of sales and marketing channels, reputation, and all of those relationships that allow them to carry out their mission to an even greater extent than they could if they sort of held it more closely.
Great. James has a question that kind of keys in on that too. How do license agreements fit into the exit strategy?
Well, and license agreements are going to fit in probably a couple of ways. First of all, you want to make sure that those licenses are assignable if the company gets acquired. And I'm thinking, by the way, when I'm talking about license, hopefully this is what James is thinking about. We want a company to have an unfair competitive advantage, and IP and exclusive licenses are part of that. And so we want to make sure that the IP and exclusive licenses are transferable to the company that gets acquired. Now, one thing that's interesting is, there's big debates, especially in software companies. A lot of people say you shouldn't pursue patents, and there's some truth to that in quite a number of cases. In healthcare, I think probably something like 99% of companies should be pursuing patents and IP. So it becomes a huge part of the value proposition, either defensively or offensively, to an acquirer.
Great. I think we have time for one more question. Here's one from Chris. As a new investor, rather than necessarily going for a home run where you expect half the companies to flame out, could you target lower risk, lower reward companies? Example, companies with stronger cash flow but lower future exit, such as 2 to 3x.
So that is a great question. By the way, there's a lot of people who are shooting for those grand slams, and what they're finding is they're getting, people who are in Uber, they've got a 40x return, but they can't liquidate it. So they have this paper profit, and now every year that it goes on, their IRR is dropping as they go on. So, if you look, I like this idea of the low risk investment. If you compare it to baseball, your average batter in major leagues gets something like a 250, batting average, meaning about 1 in 4 they're going to get a hit. And that's pretty good average. But if you look at how many of those baseball players get grand slams, it's about 1 in 1,500. It turns out those are similar ratios for venture capital. So it's better to go for some of those singles and doubles where you can get the 2, 3, 4x rather than shooting for the 10, 20, 30x and beyond. One thing I'll point out is, he asks about, the ones that are turning a lot of revenue out, for example, at this point. That does reduce risk, but of course, remember, we don't get that revenue. The revenue is only important if that is valuable to a company who's going to acquire it. And typically, acquisitions are not based on the amount of profit that the company has, but it's going to be more about how fast it's growing and how impactful it is in terms of their technology. So just keep all of that in mind. So we think time is risk. There's a lot of things that could happen in terms of regulation, in terms of competition, in terms of all sorts of things that are going to happen. So if we can get out of a deal in 2, 3, 4 years instead of 5, 6, 7 years, we'll take that anytime.
Great. Just some final notes to wrap it up. Both Rockies Venture Club and Springboard Equity are working with deals currently, and feel free to check out the websites to take a look at those. Springboard Equity is an equity crowdfunding platform, and we have a handful of deals up there that the founders would be glad to speak to you about. I'm sure Rockies Venture Club has a few that they can introduce you to as well if you're interested in doing some deal vetting. And also, if you're an entrepreneur looking to get into the crowdfunding space, Springboard is only focused in that health tech or healthcare space right now, but we'd be glad to talk to you, and in the future we will probably open up to other verticals. Getting a lot of thank yous, so I'll extend that to you, Peter. It sounds like you did a great job, and everyone's really pleased with the content. We'll be sure to get to everyone that didn't get their questions addressed after the call. We'll send out something to everyone with all the QAs from the call, along with a replay that you can view yourself or share with others. We really want to democratize this space and help others make informed decisions in the space, so feel free to share that. And if there's anything else, Peter, you want to add, go ahead, and then we can pass it over to Lyle for the final remarks if you have anything, Lyle.
No, I'll just say thank you for organizing this, and thanks everybody for coming and for your great questions, and we can certainly follow up on those ones we didn't get a chance to get to.
Great.
Lyle? Yeah, thanks everyone for participating. Peter, great job, thank you. And as Wally said, we'll send out the link, and any other questions can be directed to us at Springboard, and we'll make sure they get answered or redirected to Peter. Thank you all.
And we'll have more of these in the future, so we'll be in touch when we have them. Thanks, everyone.